Okay, dear students, this is Mustafa Mirchawala from Mirchawala's Hub of Accountancy, your SBR trainer. And today we are going to discuss a very small and a very simple area which is called Lease Modification IFRS 16. As you all know, you have almost done IFRS 16. Now I am going to discuss Lease Modification, and I have picked the data, the article from your ACCA Study Hub resources, so that in this way your ACCA Study Hub resources will also be covered. Okay, now the first thing is, what is lease modification? A change in the scope of lease, a change in the scope of lease or the consideration of a lease. For example, initially I did agreement with my lessor. I'm a lessee. I did agreement with my lessor that I have taken the asset on lease for 5 years, or I have taken as apartment on lease for 5 years. Now I'm asking them to increase the lease by 3 years, extend 3 years. So this is a modification. This is the change in scope. Okay, or the consideration of lease. Consideration means the rentals. You have changed the rentals, revised the rentals. That the most important line, that was not part of the original terms and condition of the lease. This is the real point. Whatever is not written at the inception, whatever was not part of the original contract, and later on you are revising it, then that means that is basically modification. Okay, now an example of lease modification is adding or terminating. Obviously you can add as well, like initially you got one asset on rent. After 3 years you got first floor on rent. After 3 years you are saying, now I want second floor also. Okay, so adding or reciprocal thing may happen, like initially you book 2 floors, but after 3 years you are saying, I want to minus 1 floor. Okay, is adding or terminating the right to use of one or more of the underlying assets and change the lease term. So all these things are the example of modification. Now what is the accounting treatment? This is the lessee. We are discussing the lessee books. They must account for any lease modification as a separate lease if see this if is important. So the modification will be treated as a separate lease if these two conditions are met. The first condition, the modification increases, it's not decrease, it's increases the scope of the lease by adding the right to use of one or more underlying assets. Very good. For example, initially I have taken 1 floor on rent, complete first floor on rent. Now after 3 years I am saying I need to add 1 more floor. So if you add 1 asset right of use, or 2-3 asset, then this will be treated as a separate lease contract. This is the first condition. Okay, now the second condition, just think, initially I got first floor on rent, now I am adding second floor, so the first condition is met. And what about the price of second floor? See, the consideration increases by an amount that corresponds to the stand-alone price of the increase in the scope of the lease after adjusting for any specifics of the new contract. Yes, initially I was paying 50,000 for the first floor, $50,000 per year for the first floor. Now when I add the second floor, so rent increased to 100,000. So that means exactly 50,000 for the second floor, and that 50,000 reflects the stand-alone. Or we call it a separate price, separate market price of that second floor. Okay, of that new asset. So if you meet these two conditions, then the lease modification will be treated as a separate asset. Now if you don't meet any one of the condition, then this will apply, okay, this thing will apply, but we'll do it later on after 5 minutes. Now first of all, let me give you one example for this. See this is the practical example. Even you can understand by just reading it. So listen, Dina Company entered into a 5-year lease. Agreement on 1st January X1 to lease 1 floor of an office building for $50,000 per year payable annually in advance, payable annually in advance. Okay, so initially the starting of the lease is 1st January X1 and we got only one floor, right? Then what they are saying on 1st January X3, Dina, after 2 years, see, after 2 years, this is the date of modification. Dina company and the lessor agreed to add a second floor. Okay, so addition is there. One condition is met to the lease for the remaining 3 years. The lease payment for the additional floor are 50,000. See, initially we were paying 50, now additional 50 we'll pay. So the consideration is also looks like a market price. Okay, and see, this price reflects the standalone market rate for the leasing one floor. Exactly, it's perfect. So in this paragraph both conditions are met. In this paragraph both conditions are met. In this paragraph both conditions are met. Okay, in this paragraph both conditions are met. Okay, now assess whether the lease modification should be treated as a separate lease under IFRS 16. Yes, because both conditions are met. Yes, see the answer. Under IFRS 16, a lease modification must be accounted for as a separate lease asset. See, this is the state. This is the IS. The same two conditions which I just explained. The same two conditions which I just explained. It is written here. In this case, both conditions are satisfied. Dina company is adding another floor, an additional right to use. C. First of all, they added first one more floor, so the scope of there is an addition of a right of use. Okay, and yes, the increase in payment 50,000 per year matches the standalone price. Therefore, the modification qualifies as a separate lease. Separate lease means now on 1st Jan X3. Listen. Old lease will remain same. Old lease will be continued as it is. The complete lease, amortization schedule, the depreciation, everything will go as it is, the old lease. And what about the new lease? They on 1st January X3 they will calculate the present value of these cash flows, the new cash flows, and they will make the entry. Remember this entry, ROU debit and lease obligation or lease liability credit. Okay, and this ROU will be depreciated separately over 3 years, separate. And this for this new lease obligation there will be a separate lease amortization schedule. Okay, so total separate accounting. Total separate accounting will be there. Total separate accounting will be there. Okay, now the next part. Now as a student you may ask, sir, what if one of these conditions are not met? One of these conditions are not met, then what will happen? Then we'll incorporate the modification in the existing lease. Then we will incorporate the modification in the existing lease. Okay, how? For any modification that is not accounted for as a separate lease, the lessee should, number one, recalculate the lease liability and the right of use asset to reflect any reduction in the scope as partial termination of lease and recognize any change in profit and loss. Now don't worry about it. We'll do practically. See, if we are doing addition, if we are adding something in the lease, normally the top part will qualify, then the accounting is a separate lease. But let us say if we delete something, if we reduce the lease scope, so in that case the upper conditions are not met. So in that case you need to recalculate things like your liability, your lease liability will go down and your ROU will also go down. Your lease liability will go down, your ROU will go down. So first of all you need to make an entry. Listen, ROU goes down, ROU is asset, so ROU credit. Lease liability is going down, so lease liability debit. And if there is any difference, that difference will go in the profit and loss. See, that difference will go in the profit and loss. Okay, I will do it practically, don't worry, just reading it right now. Then number 2, remeasure the lease liability. Listen, definitely when we have changed, we have done modification, so that means the future cash flows may be disturbed. So if the future cash flows or the future incremental borrowing rate is changed, so you will be calculating a new lease liability through present value working. You will be calculating a new lease liability through present value working. Now just compare the old lease liability just after modification. Just after modification you have an old lease liability, and then this new lease liability through present value of future cash flows. You will compare these two. For example, the old lease liability is 100 and the new lease liability is 120. For example, the old lease liability just after modification is 100 and the new lease liability is 120. So it is increasing by 20. So you will make the entry ROU debit and lease liability credit by 20. See, make a corresponding adjustment to the right of use for the adjustment in step 2. That's it. That is the treatment. So it's just two steps. Definitely I'm just doing it practically so you will understand easily. Now the question: on 1st of January X3, FGH entered into a lease contract to lease 2 floors of a 10-story office building. The lease is for a period of 10 years at an annual rent of 100,000 payable in arrears. Right? So that means initially we got 2 floors. At an annual rent of 100,000 for 10 years. Okay, 2 floors we have got. Now FG's incremental borrowing rate is 6% right now, and the asset will be depreciated over 10 years. On initial recognition means on 1st January X3, the start of lease, the right of use and the lease liability will be measured at 736,000. So definitely whoever would be the accountant must have made the entry ROU debit 736,000 and lease liability credit 736,000. Okay, now listen one thing. We are not doing FR level or F7 level paper. There will be no LAS or anything. Everything they will give you ready made. We just have to make one entry. That's it. Now, after 4 years, see, on 1st January X7, this is the date. This is the date of modification. Now you will see some modification. And at this date, the lease liability is 491,722. Now, they have given you ready-made lease liability. Definitely after 4 years, LAS working, lease amortization schedule working. This is the lease liability at 1st January X7, just before modification. And the carrying amount of right of use asset. Carrying amount, how to calculate carrying amount? Definitely in last 4 years we must have booked. We must have booked depreciation as well. On this date, FGH arranged with the lessor to continue the lease for just one of the floors, reducing the office space leased by 50%. Now see, so it's a discontinuation, it's a reduction, not increment. If it would be increment, then we would have met the criteria. So no more criteria met for the separate lease. Okay, so what they are saying, on this date FGH arranged with the lessor to continue lease for just one of the floors, reducing office space lease by 50%. Out of 2 floors we left 1 floor, so only half is left. The lease rental for the remaining 6 years of the lease will be 55,000 each year. FGH incremental borrowing rate is now 7%. So this is the last line is very important. Now in future we'll have to pay this much rental and this is the rate. So we need to calculate new present value as well. We will be calculating new present value, and for that new present value they have given you the annuity factor on 7% for 6 years. Okay, they have ready-made given you annuity factor. Now first thing, be active. On 1st January 7, just 1 hour before the modification, this was your total lease liability and this is your total ROU. But suddenly, because of the change in contract, everything goes half. Okay, so lease liability just went down by half, ROU went down by half. Okay, so let's make this entry and the difference will go in the P&L. First thing, this is the first step. Listen, the change of the lease meets the definition of the modification. Yes, it is a modification because the terms we changed was not part of the original contract. See, this is written here. Now, the modification decreases rather than increases the scope of the lease, and therefore it is not accounted for a separate lease, right? Because it did not increase the anything, and there is no discussion on the separate consideration. So the conditions which I taught you are not met. Instead, the lease liability and ROU are measured as follows. Now, what they are saying, the first step, the lease liability and ROU are reduced by exactly 50%. Can you see? Okay. So what was your lease liability at this date, at 1st January? It was 491,722. Now simply use your calculator and divide it by 2. Divide this by 2. And also this 441,600 is ROU. Also divide this by 2. So you lost half of it. Okay. You lost half of it. So let's make the entry. 491,722 divided by 2 is 245,861. Okay, so when your liability goes down, it goes on the debit side. Similarly, 441,600 divided by 2, your ROU, your right of use, will go down by 220,800. And when ROU decreases, it goes on the credit side. So now check the entry. Debit side is high, credit side is low, so there will be a difference. There will be a balancing figure on the credit side which will go in the P&L. Whatever will be the balancing figure will go on the P&L. Okay, so this is the first entry you need to make every time you are doing such modification. Now be active. Out of this 491,722, half of the liability is gone. Half of the liability is just gone. So that means half of the liability is left. Half liability is gone. So half liability is left. So what is your liability right now? Your half remaining liability is 245,861. Now the next step is calculate the new liability. Remaining new liability. So for remaining 6 years, you have to pay 55,000 rentals. Same 55,000 rental every year. So same cash flows and equal interval of time. Such series of payments are called annuities. So this is the cash flow. Which is 55,000. This is the cash flow, single cash flow, which is 55,000. And this is the annuity factor, so you multiply it. This is your new liability. This is your revised new liability. Is here. Okay, so just think, this is your revised new liability, this was your existing liability. So because of this modification, now your liability is going up by this amount. your liability is going up by this amount. Okay, so what you have to do, you have to adjust this increase in liability. You need to adjust this increase in liability with ROU. So see, this will be the entry: debit ROU and credit lease liability, debit ROU and credit lease liability. Okay, now here the question has been ended, the question is over. Here the question is over, right? Listen, but let me tell you something more. Now what will happen in the future? In the future you need to first calculate the new ROU. Can anybody tell me the new ROU? Yes, this was your ROU just before modification on 1st January X7 441600, and you just reduced it by 220800. You just reduced it to half. You just reduced it to half. So now the remaining ROU which is left is 220800. The remaining ROU which is left is 220800, and then you just increased it by, see, you just increased it by 16324, 16324. So can anybody tell me what is the revised ROU? It is 237124. 237124 is your revised ROU. Now this ROU will be depreciated. Listen, it's an asset. This ROU will be depreciated over the remaining lease life, that is 6 years. This will be depreciated over 6 years, and every year you will be booking depreciation, number one. Then for the lease amortization schedule, this is your new liability. This 262185 will be your new liability, and now you will start your lease amortization schedule with this liability. You will be starting your lease amortization schedule with this liability, you will be starting your lease amortization schedule with this new liability and all. Okay, so this is how it will work. Okay, so finally let me give you some summary. The summary is, you must know the definition of modification. Then modification is treated as a separate lease contract when these two conditions, see, these two conditions are met. When these two conditions are met, okay, right? And if these two conditions, if one of these two conditions even are not met, then modification will be incorporated in the existing contract, and then you need to follow this. Okay, right? So you can better read it and you can work hard. Please work hard and make your teachers proud. If you want to see the solution, see, this is the I will add these slides as well. Thank you and take care.